Signal episode 17, we explored India's information technology sector, a structural pillar built on cloud, automation, and AI-driven transformation. Today, in Signal episode 18, let's shift our focus to yet another high-impact sector, automobiles and the EV transition, a space that blends manufacturing strength with once-in-a-generation mobility shift. As always, let's begin with the strategy of the week, followed by story of the week, a fun fact, market highlights, and conclude with a meaningful quote of the week. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. When we speak of India's automobile sector, we are referring to a powerful economic engine, one that spans manufacturing, mobility, energy, technology, and consumer behavior. Today, this sector stands at a pivotal intersection. The traditional ICE manufacturing or internal combustion engine manufacturing, or commonly known to us as petrol diesel vehicle manufacturing, and modern, sustainable, green, electric vehicle manufacturing, which represents India's emerging mobility ecosystem. Several structural factors support the long-term potential of this sector, like a rising working age population, increasing disposable incomes, urbanization, and broader access to financing continues to drive multi-year demand across two-wheelers, passenger vehicles, commercial vehicles, and tractors. EV adoption is accelerating across two-wheelers, fleet mobility, and urban passenger vehicles. The transition will be phased and success will be led by companies with strong technological partnerships, advanced battery capabilities, and well-established supply chains. Leading players continue to consolidate market share supported by strong supply chains, trusted brands, and wide distribution reach. These companies handle downturn more effectively and tend to outperform during recovery cycles. Automobile volumes move in cycles influenced by festive seasons, financing conditions, commodity prices, and rural income trends. But India's long-term mobility demand is structural, making this an important sector for patient investors. So how should investors think about sizing and allocation in this sector? Diversified equity funds provide broad exposure to leading auto and ancillary companies, offering balanced long-term participation. Sectoral or thematic auto EV funds facilitate a more concentrated portfolio, but they must be sized thoughtfully because of sector's inherent cyclicality. Direct stock investors should focus on companies with clearly defined EV strategies, competitive cost structures, strong order books, resilient margins, and credible long-term roadmaps. The core principle remains that mobility is evolving, and investors who combine discipline with thoughtful sizing can participate in both the maturity of ICE leaders and emergence of India's EV future. As always, a guidance from SEBI registered investment advisor ensures that this allocation is tailored, balanced, and appropriate for long-term goals. On that note, let's step into story of the week. Let's meet Aarav, a 38-year-old engineer and disciplined SIP investor. In 2019, the automobile sector experienced a pronounced slowdown, one of the sharpest in decades. Sales contracted across two-wheelers, passenger vehicles, and commercial vehicles. Inventories rose, demand softened, and sentiment weakened. Many investors exited in panic. Aarav chose to speak to his SEBI-registered investment advisor to understand and revisit the context. India's expansive middle-class mobility demand, increasing rural income cycles, and long-term transition from traditional ICE vehicles to cleaner, sustainable, and smarter EVs, reaffirmed the long-term outlook, giving Aarav the confidence to maintain his allocation and continue his SIPs to benefit from lower market valuations. From 2022 and onwards, the sector began to stabilize. By 2023 and 2024, demand strengthened across multiple segments, production rose, and exports gained momentum. Aarav's discipline allowed him to benefit from both cyclical revival and structural EV opportunity. Aarav's story leaves us with a timeless rule. Cyclical sectors reward investors who remain patient, informed, and appropriately allocated. And this becomes even more effective when guided by disciplined, structured, and well-established frameworks under the care of a SEBI-registered investment advisor. Did you know that world's first speeding ticket or fine in 1899 was issued to an electric car driver in New York? EVs have been fast from very beginning. Markets spent most of the week in a narrow range but reacted positively to RBI's rate cut on Friday. The Sensex closed at 85,712 points, up by about 6 points from last week's close. The Nifty ended near 26,186 points, down by about 17 points from last week's close. Rate-sensitive sectors led the move after 25 basis points rate cut, with PSU banks, financials, IT, and autos being key gainers, and defensives like FMCG and pharma lagged. The rupee ended near 89.96 per US dollar, remaining under pressure driven by foreign outflows and global risk sentiment. Overall, a neutral data-driven week with markets consolidating, sectors reacting to policy cues, and investors watching the currency trends. Our quote of the week comes from the legend himself, Sir Ratan Tata. I don't believe in short-term goals. I believe in long-term vision. This simple but profound quote captures exactly what long-term investing requires, especially in automobile and EVs. In a world of cycles, volatility, and shifting sentiments, long-term vision ensures you remain steady, focused, disciplined, and positioned for structural long-term growth. We are building a strong community of astute, aware, and ambitious long-term investors. If you're one of them, why not like and subscribe us and tell us in comments which mobility trend you think will redefine India's future.